Rachel Rodgerson. We're really excited to talk about reverse mortgages. Super timely moment to do so. How are you doing?
Good. Thanks, Paul. Thanks for having me on. Appreciate it.
Yeah, pumped. We have not had a chance to talk much about demystifying reverse mortgages. And for the viewers who are probably looking at considering that, can you first start off with, a quick introduction and like what are the benefits of a reverse mortgage and who is it usually for?
Absolutely. So reverse mortgages, they've been around for a long time, but like you said, they do have a lot of myths, surrounding them. So reverse mortgages are really, they're for Canadians that are 55 and over that are really looking to just use the equity in their home to do a variety of things. So, some of the top, I would say top five are just really enjoying the quality of life that you enjoyed before the retirement age. So, mortgage rates have gone up drastically. So the payments on everything are a lot higher, and that is eating into that income that you have, in those years. So as opposed to spending all your money on your mortgage payments, why not spend that money and do something that you enjoy? So aside from that, it's, you can lend money to your kids for a down payment on a house that they can go out and buy a place. You can buy a recreational property or an RV and go enjoy life. So that's what it's targeted for. The great thing about a reverse mortgage, and I will just, I answered my own question in my head here, is that it's different than a regular mortgage in the fact that there are no monthly payments. So those payments are not coming out of your pocket. The interest is accrued over the lifetime of the mortgage and just added onto the balance. The balance is not payable until the property is sold or it's refinanced or there's a major life event. In that case, the family would take care of that.
Got it. So you're saying like, because yeah, I have my parents looking to reverse mortgage and like, playing devil's advocate. I said, well, if and they're currently still working. So I said, well, if you just get a regular refinance mortgage and like, like whatever, 6.5% at the time of recording, and then you
Mhm.
store that in like a savings account, well, you've accessed that at a lower interest rate. And if that money is then still used for whatever you want recreationally, I think that
Mhm.
it's done it and it's just cheaper, right? Now, if they were retired and they can't qualify for more mortgage,
Mhm.
they don't their pension payments, which can be used for mortgage, maybe isn't enough. That's where I would see, well, there's no other choice, and you should enjoy life, and there's no stress of monthly payments until you're kicking the can down the road, right? Which is okay,
Absolutely.
because I think they deserve that. But I mean, are there situations where it doesn't really make sense to get a reverse mortgage? I mean, maybe this was one of them, like just to play devil's advocate.
Yeah, I mean that there are going to be situations where a traditional mortgage does make sense, if you're doing it for tax purposes or something like that. But the great benefit of a reverse mortgage is that the proceeds is tax free. It's not taxable income. So let's say someone does take a reverse mortgage, it's not going to affect their OAS or their CPP. So, and the rates right now, I know you mentioned 6.5 as of today. The rate for a reverse mortgage right now is 7.64. So there's not much of a difference. So if you're looking at it from a cash flow basis on a monthly, monthly cash flow, reverse mortgage is the way to go. If you have that monthly cash flow coming in from employment sources, maybe you wait a little bit. So situations where it might not make sense is if the person is closer to 55, the amount of money that they're able to access in their home is going to be lower than, let's say, if they're 70 or 75 years old. So a reverse mortgage, the loan amount is really tiered based on age.
Got it. Interesting. Okay, cool. Yeah, thanks for clarifying. So are there any myths about a reverse mortgage that we should just clarify here?
Absolutely. And yeah, Paul, I mean, you and I have probably heard these many times. And, because reverse mortgages have been around for so long and there has been, one or two main providers in this space for a very long time. Um, a top three myth, it would be the bank's going to own my home or I'm going to lose my home. So this is absolutely not true. The homeowners remain on title. They're the only ones on title. There's no ownership change. So that is something that is really important to remind borrowers that are looking at a reverse mortgage is that, nothing changes. It's the same as a mortgage, except instead of those monthly payments coming out, it's just getting added onto the balance. The other one is I'm not going to have any equity left in my home when I pay out my mortgage. This is also not true. Especially in the Vancouver and Toronto markets. The the values of our homes are increasingly going up. We only lend reverse mortgages up to 55% of the home value, and that's on the maximum end. So, you're looking at half of the value of your home that you're actually taking out in equity. And so it's just, you're going to have money left over considering the value of your home keeps going up. And then the small amount of interest that is getting added is not going to catch up to that. And then the last one is, what happens if I owe more than my home is worth? So, for example, if values do decrease drastically, for an example, I guess if you take out a mortgage of 400,000 and then your property drops to 300,000, you're never going to owe more than the value of your home. So you'll only owe that 300,000.
Got it. Super useful. And so just again, maybe like an illustration to bring it all together. So how does it work?
Yeah.
So someone will hopefully, so they'll talk to me. I think it's makes sense for them to explore the conversation. Let's have an example of a $1 million property. Someone is 65 and no job. So let's talk about just like what that would look like monthly in terms of how much payments they're getting. Assume, whatever interest rate you want to
Absolutely.
assume, or just a lump sum. Let's walk through that, and then let's also finish at the point where that person passes on, the kids take over the property. They're like, oh shit, we've got this big mortgage now. Let's just go from start to finish on that.
Totally. So let's just say there's one borrower, 65, like you said. We'll go with 40% loan to value on the home. So that means that they can borrow 40% of the value of that $1 million. So 400,000. Let's say they only want to take $100,000 this year. They can take out that $100,000 and they only pay interest on that 100,000. That remaining 300,000 will be available to them for the lifetime of their mortgage, and they can take it at any time. The borrower can come in and take a lump sum of 20,000 if they want it, 30,000 at no cost to them.
It's like
That
a
is
line of credit
reserved.
almost. It sounds like
It
it.
is like a line of credit, but they
Right.
don't pay for anything that they're not using, which is the
Right.
beautiful part.
Oh, nice. I didn't
So
know.
they've tapped into that equity, and it's no cost to take that money out whenever they need it or want it. It's a quick call. So let's just say that this borrower takes, they're 80 years old, they've taken their 400,000, and in the scenario where they have passed on, the family actually has a year to be able to refinance, sell the property, or do whatever they want with it, really. So we're not in there going, okay, it's time, it's ready to go. That is up to the family or whoever is in charge of handling the estate. And, a refinance, no cost, sell the property, no cost. It just works like a regular
Got it.
mortgage.
And refinance, you mean like basically the loan gets moved to another.
Yeah, sorry. So, yeah, if there's an ownership, let's say one of the children come in and they want to buy that home, they can come in and they can take over, they can move the loan from Bloom to, let's just say, a Schedule A bank and take over that mortgage.
Love it. And let's finish off with why Bloom is different than Chip and Equitable Bank, for example. Like what makes you
Absolutely.
different?
Awesome. Well, first of all, we're very new to the scene. So we have had a chance to sit back and be like, okay, this is how things are being done. And, this is how we can be different. So we come from a very tech background. So our whole back end system is very automated and it's quick. So the great thing about Bloom is that we have an internal sales team who is only specializes in reverse mortgages, and they're the most kind, helpful people. So they'll come in and they talk to the clients and they make sure that this is the right move for them. And we do check-ins. So we check in every year we check in and make sure that the borrower is doing well and that if they need anything, and the draws that I just talked about, if ever there's a need for more money, just pick up the phone, let us know what's happening, and we'll get that to you right away.
And that's the draw. So if 400,000 limit, you only need 100,000 for now. You're only paying interest
Yep.
on the 100,000. So is that unique to
Yes.
you, or do other people, lenders, not do that, or?
It is unique. Every reverse mortgage company is set up differently. So some do, a monthly income, some do lump sum. So this one is unique to us in the fact that it'll be in your bank account right away. It is going to be very quick. There's no huge fee. There's no fees, but there's no fees or huge process to go with it. There's no reevaluation of the property. So it's just very quick and very simple. And you have a dedicated person at Bloom to speak to whenever you need anything.
Love it. Rachel, thanks for your time. That's super useful
Thank
and
you, Paul.
information for an
Appreciate it.
icebreaker. Thank you for your
Awesome.
time.
Thank you. Enjoy your day.
Thank you.